So what if you could generate consistent income from the options market? And I don't mean through random bets, but with a clear, repeatable system. Well, today, we're diving into exactly that, a strategy called the income wheel.
The big question for so many traders is pretty simple. How do you actually generate weekly income by selling options? It's a goal that can feel super complex, but the strategy we're breaking down today, well, it offers a surprisingly direct, step-by-step path.
The whole idea here isn't about hitting a home run on one single trade. Nope, it's about building an income machine. This strategy is a continuous cycle, a rotation between selling puts and selling calls. Think of it like a wheel that you just keep on turning, one that's designed to spin off income week after week. All right, so how do we get this wheel turning? Before we jump into the action, we got to set the stage. There are a few essential tools and some really simple rules that form the foundation for this entire system.
Okay, let's start with the single most important rule. And I mean it, you absolutely cannot ignore this one. Only use this strategy on a stock you would genuinely be happy to own. You have to be willing to hold it for a while. Once you've got that down, our second key idea is a simple way to time our trades using what we're going to call market heat. So our first tool is something called delta. The easiest way to think about it is as a quick gauge for the probability of a trade going against you. For this strategy, we're not taking any wild chances. We're aiming for a real sweet spot, a delta between 15 and 25. That gives us a really high probability of success while still letting us collect a decent premium. And here it is, our market heat gauge, the RSI, or Relative Strength Index. It's a simple indicator that measures momentum. So when the RSI is low, the market is cold. Fear is high, everyone's selling. But when the RSI is high, the market is hot. Greed is kicking in and everyone's buying. This little gauge is going to tell us exactly when to make our moves. Okay, we've got our rules, we've got our tools. It is time to start the cycle. Phase 1 kicks off with selling puts. And the beauty of this step is that we've got two ways to win. Either we collect the premium as pure income, or we get to buy a stock we already wanted anyway, but at a discount. Not bad, right? So here's the exact game plan. We're looking for a put with about 30 to 45 days left to expire. That's the sweet spot for time decay. And it's got to be right in our 15 to 25 delta range. But here's the real key. We wait for a red day. We're stepping in when other people are getting scared because that's when premiums are juiciest. And we confirm this with our heat gauge. We only pull the trigger when the RSI is cold, below 30, signaling that the stock might be oversold. Now, sooner or later, it's going to happen. The stock price will drop below your strike price on one of these trades. And when it does, something happens that makes a lot of new traders just totally panic. You get assigned. But in this strategy, that is not a problem. In fact, it's part of the plan. So what does it actually mean? Let's be perfectly clear. Getting assigned simply means the trade went against you, and at expiration, you now own 100 shares of the stock at the price you agreed to buy it for. That's it. Nothing more, nothing less. And of course, the first question that pops into your head is this a loss? Did the whole strategy just fail on me? The answer is a huge, resounding no. This isn't a failure. It was always part of the plan. Remember that first rule? We chose a stock we wanted to own. Getting assigned isn't the end of the road at all. It's the trigger that activates the second half of our income wheel. And that brings us right to phase 2. Now that we own the stock, we can immediately put those shares to work for us. It's time to start selling covered calls and generate even more income from this asset we now hold. And hey, take a look at these rules. Notice a pattern here? We're still using that same 30 to 45 day expiration and that 15 to 25 delta. But now the conditions are completely flipped. Now we're selling on a green day, capitalizing on all that buying excitement to collect higher premiums. And we wait for our heat gauge to be hot, an RSI above 80, which signals the market might be getting a little too greedy. This slide right here just lays out the beautiful symmetry of the strategy. I mean, look at this. We sell puts when the market is cold and fearful, and we sell calls when the market is hot and greedy. It's a system designed to do the exact opposite of the crowd. We're systematically selling into panic and then selling into euphoria. So what happens after we sell that covered call? Well, there are two simple outcomes. If the stock gets called away, great. We've sold our shares for a profit on top of all the premium we've collected. If it doesn't, we just keep the premium and we still own the stock. Either way, we generated income, and the next step is exactly the same. You just rinse and repeat. If your shares were sold, you're right back to phase 1, cash in hand, waiting for the next cold, red day to sell another put.
If you still own the shares, you just wait for the next hot green day and sell another call. The income wheel just keeps on turning.
And that leaves us with a really powerful final thought. So much of trading is about managing our emotions, that market heat of fear and greed. But what if the key to managing all that isn't some complex prediction model, but just a disciplined, repeatable system? A system designed not to fight emotion, but to actually harness it.